It appears that Bitcoin is currently experiencing a weekly close above the 13-period and 21-period exponential moving averages on the weekly chart, for the first time since reaching the $69,000 level. This is a noteworthy occurrence, as it represents a key level of support and resistance that is closely monitored by traders when making investment decisions. The next level of significance to keep an eye on is the 200-period weekly moving average, which currently sits at around $25,000, coinciding with a previous local high reached on August 15, 2022. If Bitcoin continues to break out, it may encounter resistance at the $25,000 level. However, maintaining support at this level is crucial. It is important to note that a positive close above a key level does not necessarily indicate a sustained upward trend, as market conditions can change rapidly. At present, it seems that Bitcoin is gaining bullish momentum and has already liquidated nearly $1 billion worth of short positions, further strengthening the bullish sentiment. Despite the inversion of the yield curve, interest rate hikes by central banks, and concerns of a global recession, it appears that these factors have already been priced into the market during 2022 and that Bitcoin is now poised to move higher. If the upward trend continues, the price levels to watch for potential profit-taking by the end of 2023 would be between $48,000 and $52,000, based on key Fibonacci levels and previous market cycles. However, it is important to note that these projections are speculative and that a variety of factors could potentially cause the price of Bitcoin to fall below $15,000. Despite this, it is unlikely that this will occur after a prolonged bear market of 13 months, as the market is currently in favor of bulls, and the deeper the price of Bitcoin falls, the more difficult it becomes for bears to continue pushing the price lower. Additionally, many Bitcoin holders and believers have demonstrated that they view $16,000 and $17,000 as attractive entry points, contributing to the recent rally and liquidation of short positions. The Wall Street cheat sheet psychology of a market cycle refers to the emotional and psychological stages that investors go through during the different phases of a market cycle. The market cycle is typically divided into 4 stages: the accumulation phase, the markup phase, the distribution phase, and the markdown phase. The accumulation phase is when smart money, such as institutional investors, start buying an asset quietly and at lower prices. They accumulate their positions in anticipation of a future price increase. The markup phase is when the smart money's buying causes prices to rise, and the general public starts to take notice. As prices continue to rise, more investors, including retail investors, begin to buy in, driving prices even higher. The distribution phase is when the smart money starts to take profits by selling their positions to the general public, who are still buying in at higher prices. This selling causes prices to start to decline. The markdown phase is when the general public starts to panic and sell their positions, causing prices to fall even further. This is the stage where most investors lose money. The Wall Street cheat sheet psychology of a market cycle suggests that investors should focus on buying during the accumulation phase and selling during the markup phase. This approach can help investors avoid the emotional pitfalls of buying high and selling low, which is a common mistake made during the distribution and markdown phases. It's important to note that market cycles are not always predictable, and different assets can have different market cycles. It's important to study the asset and its history to be able to identify patterns and make decisions accordingly. Let us know what you think about our price analysis. Leave a comment down below and don't forget to subscribe. Thank you so much for watching.